Welcome to CFTC Talks. I'm your host, Andy Bush, Chief Market Intelligence Officer for the CFTC. Hey, just a quick reminder, as always, there's a disclaimer at the end of the show that's important for you to listen to. Today, we have a very special guest from the U.S. Treasury Department. Joining us today is Counselor to the Secretary of the U.S. Department of Treasury, Craig Phillips. Mr. Phillips joined the Treasury in January of 2017 and assists the Secretary in a wide range of matters, including domestic finance, domestic financial institution policy, housing finance, and regulatory reform. From 2008 to 2017, Mr. Phillips served as a managing director and member of the Global Operating Committee of BlackRock, Inc. Mr. Phillips was the global head of the Financial Markets Advisory Group in BlackRock Solutions, which provided analytical and risk consulting services to a wide range of private and public sector organizations globally. He has been instrumental in many issues at the Treasury, but one of the areas that doesn't get enough attention is the work on the regulatory reform being done under his watch. To that end, there are several reports out from the U.S. Treasury on policy issues, on the Policy Issues website page under regulatory reform that are worth reviewing and reading, truly. Now, these reports are essentially tutorials on the U.S. financial system, problems within that sector, and what to do to fix them. And really, for everyone in finance, these are they're just an amazing resource, and I would recommend them to be distributed to all of those who are entering into this field. And today, we're so pleased to have Craig on to discuss the latest release of a report entitled NonBank Financials, Fintech and Innovation Report. Counselor Phillips, welcome to CFTC Talks.
Well, Andy, thank you for those kind words. We have a great policy team at Treasury that we've worked on the reports, and we're glad to share our thoughts with you further today.
Well, thank you. To start out, I think it might be a good idea to level set our discussion, Craig. So can you tell us about the executive order that led to this series of reports?
Yeah, President Trump established the core principles for the regulation of the financial system in his executive order that he issued in February of 2017. That order directed the Treasury, under the direction of Secretary Mnuchin, to identify laws, regulations, guidance, reporting, and other requirements or policies that inhibit the federal regulation of the U.S. financial system in a manner consistent with those core principles. These core principles really are fundamental values, such as empowering Americans to make independent financial decisions, avoiding taxpayer-funded bailouts, and fostering economic growth and vibrant financial markets through rigorous regulatory impact analysis. But they also identify the importance of allowing our American companies to be competitive with foreign firms in both domestic and foreign markets. This includes assessing how we engage in international financial regulatory negotiations and forums. And finally, the principle of making regulation more efficient, effective, and appropriately tailored stands out to me. It's an important step in restoring public accountability of the financial regulatory agencies and rationalizing the federal financial regulatory framework. So we approach this task by doing extensive outreach to market participants as well as substantive research on regulations and underlying analysis. We decided ultimately to partition the work to properly cover every segment of the financial system in sufficient detail, which resulted in a total of 4 reports. We covered banks and credit unions, a sector highly impacted by the Dodd-Frank Act, in a report issued in June of 2017. We covered the capital markets in a report issued in October 2017. That same month, we issued a report covering asset management insurance. This latest report, issued just last month in July 2018, covers non-bank financials, fintech, and innovation. For the fintech report, we met with or received submissions from over 232 parties that shows just how broad-based this topic is. We personally believe that it was impossible to truly understand the impact of regulation and the potential for alternative approaches without engaging extensively with market participants, which we've done throughout the series. The final report has over 81 discrete recommendations, all of which we think are focused on in improving the financial economy as per the core principles.
Well, let's take a step back here and look at the big picture, since you kind of brought it up. I guess the question I have is, why did Treasury decide to dedicate a report to non-bank financials, fintech, and innovation?
Well, through our work, we consistently heard that enabling innovation in the financial services sector is of critical importance. So innovation in many respects is driven by new technologies and the constantly expanding uses for data. Given the increasing reliance by consumers and businesses on mobile applications, technology is likely to drive nearly every aspect of innovation in financial services. We believe regulators must participate in a public-private effort to understand and explore the drivers of these changes. So it's important to explore this topic and that background is an important part of the FinTech report. We also found that regulations that arose since the financial crisis, particularly the Dodd-Frank Act, resulted in large segments of the financial services migrating from the banking system to non-bank financials. So exploring that trend itself was quite important. And finally, a large amount of innovation is occurring at fintechs. We define fintechs as independent companies providing some element of products, services, or technologies relevant to the financial services sector. How we license and regulate these companies is important, a topic that we explore in this report. At the same time, many of these companies provide services to and partner with mature financial institutions, a trend that Treasury very much supports. These partnerships and interactions require potential modifications and enhancements to a variety of regulatory principles and guidance. For all these reasons, doing the FinTech report became a very high priority.
Yeah, that makes a lot of sense. I guess my next question is, so if that's the background on this thing, what are the major themes in the Treasury's findings in the report?
Well, one of the overarching themes is that, first of all, innovation is incredibly important. For the U.S. to be and remain as competitive as we are, we must innovate. The second is the economy is increasingly digitized. Combined with increased connectivity with mobile devices, there's an opportunity to truly revolutionize the delivery system for financial services. And finally, there's a tremendous amount of capital in technology and fintech chasing this opportunity. This is in startups, but it's also in extremely large global telecom and other data providers. So it's an area for the U.S. to have a tremendous competitive advantage. I would kind of categorize our findings in four different ways. First, we advocate for a regulatory approach that makes better use of consumer data in financial services, such as enabling credit decisions. This should be adopted in a way to both protect consumers and also assure that they have choice in these matters. Examples are how data aggregators collect data from financial institutions, once that's approved by consumers, to give a quicker snapshot as a basis of a credit decision. A more detailed example is how lenders access IRS records, also approved by consumers, and make those available to lenders. The second category is we recommend combating regulatory fragmentation and overlap, both at the federal and state level. This has been a consistent theme throughout our reports per the work on the core principles. Treasury supports the OCC's effort to launch a special purpose national bank charter for fintechs. We also recommend efforts to harmonize state regulations through better coordination. This could take the form of a model law, for instance. Another example of coordination are efforts around the nationwide multi-state licensing system to reduce duplicative regulatory requirements and promote greater information sharing and coordination. The third area is across the non-bank financial sector, a number of activity-based regulations have become outdated in light of technological advances. These are market segments such as loan origination and lending, loan servicing, debt collection, payments, and wealth management advisory services, among many others. And the fourth and final area is we identified the need to allow for responsible experimentation in the private sector on a coordinated basis across regulators. Frequently referred to as a regulatory sandbox, we must sort of create an environment to incubate innovation responsibly across the various segments of the financial services economy.
Well, I read the report, and one of the things in there that I really liked, of course, is the discussion about a regulatory sandbox. This is something that the CFTC and Lab CFTC has been advocating and working with our partners on as well. And I just think it's really important it's an important concept for innovation. Maybe you could walk our audience through exactly what this is.
Sure. Regulatory sandbox is a term that was coined overseas, I believe first in the UK and later in Singapore. In short, it refers to a policy framework that relaxes specific legal and regulatory requirements for a fixed period of time, which allows financial institutions, possibly including fintechs, to experiment with innovative products and services. So how might this apply? Let's say a vendor has created a unique approach to credit scoring that provides an alternative to traditional methods and incorporates a wider set of data and employs artificial intelligence, for example. The target market for this product may be banks as well as fintechs. The concept of the regulatory sandbox would allow permissioning for the use of this new technology in a controlled and supervised environment. This would establish a proof of concept, but also create the means of validating the results and making sure they conform with other regulatory requirements, such as a range of consumer protections that's enforced by the BCFP. In the U.S., due to our fragmented regulatory system, the successful launch of a regulatory sandbox by necessity must involve the coordination and support of multiple regulators. In some cases, is at both the federal and state level. A financial provider needs to have comfort that all regulators to which it's subject have agreed on an approach to relaxing the requirements in a consistent and predictable manner. This experimentation has to be, of course, sound and protect the interests of consumers and businesses as customers of the financial institutions. Likewise, after the trial periods, there should be an appropriate mechanism to permanently implement revised regulations or guidance as appropriate. So Treasury recommended that financial regulators periodically review existing regulations as innovations occur and new technologies develop and determine whether the regulations fulfill their original purpose in the least costly manner. But the regulatory sandbox is one means for them to do so. Treasury advocates for a true public-private partnership to foster innovation. Innovation hubs such as Lab CFTC provides access points to regulators for emerging firms and technologies, which has a dual benefit of not only providing firms more regulatory clarity, but also facilitates information sharing with the regulators themselves.
Yeah, I think that's an important point. Let me just read one line from the regulatory sandbox section that I thought was really important. The regulatory environment should instead be flexible so that firms can experiment without the threat of enforcement actions that would imperil the existence of the firm. And I think that's hitting the cover off the ball, providing that environment. So I totally understand why Treasury is advocating this. I think that's wonderful. But let me just say, let me ask this question, because I think this falls out of that. Is that why is data and the digitization of finance important for innovation in financial services? I mean, maybe a few examples would be helpful for our audience to understand this.
Sure. Well, converting information to digital form has made it possible for data to be electronically stored, transmitted, and analyzed. This creates the ability for near instantaneous access and propels substantial innovation in all financial products and services. Let me just give you some figures that we cited in the report. First of all, nearly 90% of all U.S. adults are online. Today, more than 50% of people with bank accounts use mobile devices to access those services. That's up from just 20% in 2011. Globally, there's over 27 billion devices connected to the Internet. That's frequently referred to as the Internet of Things, and that figure is expected to rise to over 125 billion by the year 2030. So it's really critical that the regulatory environment's modernized to allow financial providers to take advantage of the benefits of accessing this data to support products and services. It also appeals to the trends and preference of consumers and businesses to access services in a remote manner. So give me an example. Data aggregators, for instance, play a role of collecting and to facilitate access to consumers' data by collecting and organizing the data and making it accessible at key decision points for a financial provider. Treasury made several recommendations concerning the consumer's control over permissioning this access to their data, clarifications of the financial institution's responsibilities, and the best practices on how to access this data, preferably through an API as opposed to a screen scraping approach. Given the potential for damaging breaches of data, the FinTech report also discussed the importance of developing a robust and consistent approach to disclosing and responding to data breaches. The report offers a wide range of regulatory recommendations in order to promote the optimal and safe use of consumer data to improve both the access and the terms of financial products.
So then how does Treasury recommend regulators approach the implication of these innovations, such as like cloud computing, big data, machine learning, and artificial intelligence?
Well, look, each one of those items you mentioned are elements of the potential of scale. So we need the right tools to make the most effective use of data availability in scale. And these cloud and modern technologies, such as machine learning, artificial intelligence, are exactly those tools. So what are the benefits? First of all, it promotes scalability and speed, which reduces cost to the consumer of financial services. Secondly, enables extremely large-scale data storage management, or the so-called big data opportunity. Thirdly, it accesses secure and resilient infrastructure. So the reliable access to the data, but also the protection of the data is incumbent in the professionalism of the cloud and other services. And finally, is it removes the limitations arising from data localization. So Treasury makes numerous recommendations concerning regulations that relate to vendor management and data localization that would have to evolve to allow the financial sector to take greater advantage of these tremendous innovations.
Well, both non-bank financials, non-bank financials are comprised of both the traditional style company and fintechs. And fintechs typically deliver services without the bricks and mortar footprint. So how are they different, and why are they both important?
Well, first of all, the world's changed since the crisis. Many institutions that were large non-bank financials after the crisis became deposit gatherers. This includes credit card companies, certainly specialty finance companies, and investment banks. So first of all, the sector changed after the crisis. But as a whole, whether it's a virtual company as a fintech or a bricks and mortar company, collectively they still provide a wide range of credit and other services to the economy, and a lot of business has moved out of the banking systems, as I mentioned. So Treasury's view is whether they operate in a traditional format as a company with physical locations or as a fintech, that they provide substantial benefit to the financial services industry. In addition, non-bank financial companies generally do not gather deposits. So as such, they're not dependent on the federal support provided by deposit insurance. So that's a positive attribute in protecting against taxpayer funded bailouts. And finally, the key is the level playing field. Treasury believes that the level playing field is very, very important. So companies offering similar services should be subject to similar regulatory treatment for those services across the economy, regardless of the form of the company.
Great point. I was just thinking about marketplace lenders, and I was just wondering, because of this report is different from the banks and the credit unions to some extent, are these marketplace lenders, are they really friend or foe to banks and credit unions? I mean, I guess the question is, what are Treasury's top recommendations for this segment of fintechs?
Well, look, I mean, they are friend and foe. So fintechs, first of all, are competing with banks and credit unions, and so therefore they're competitors. But there's also a very high level of collaboration, and Treasury really wants to emphasize the benefit of that collaboration. Fintech lending platforms can help generate loan production that can be funded by the depository institutions. They can also be valuable third-party service providers that can support banks and credit unions' access to customer data and processing speed and improvements in costs. So a top recommendation we made is that the federal banking regulators improve the current tailoring and guidance on third-party vendor management that would facilitate the ability to engage fintechs as service providers to enhance innovation. This would involve the development of a better framework to regulate bank partnerships with fintech providers by applying strong and better tailored regulatory oversight. It also could involve modifications of the Bank Holding Company Act that would make it easier for firms to invest in innovation-related opportunities. Secondly, Treasury recommended Congress codify the valid when made doctrine to preserve the functioning of the U.S. credit markets and the longstanding ability of banks and other financial institutions, including marketplace lenders, to buy and sell validly made loans without the risk of coming into conflict with state-level statutory requirements such as user limits. So in short, we see the fintech sector as friend of the banking segment and increasing opportunities to partner and perhaps acquire a capability through capability that's incubated in a startup format.
That makes sense. All right, last question before I let you go. And of course, you knew this was coming. I noticed that the report provided limited commentary on crypto assets and distributed ledger technology, which is a very, very hot topic for the financial industry. Why was that, Craig?
Well, look, in the FinTech report, we did highlight that distributed ledger technology, or DLT, like other innovations, may play an important role in financial services. We're already seeing applications in commodities and securities trading and settlement as just one example. So while it's not the focus in the U.S., central banks around the world at the same time are also studying the potential impact of a tokenized fiat currency. Some believe that DLT also could play a role in financial infrastructure for interbank or other payment processes. So in short, DLT, blockchain are really important innovations which we do comment on. The connection of tokens, however, is a slightly different matter, and that raises the concept of crypto assets and how they relate to the evolution of DLT, and it's a very much studied product. So in March, topic. So in March of 2018, the G20 for the first time commented on crypto assets and assigned the Financial Stability Board, FSB, working with FATF, to monitor crypto asset markets as part of its ongoing assessment of vulnerabilities in the financial system. So first of all, at the international level, there's a significant amount of review ongoing in which the U.S. is a very interested participant. So at Treasury, the Secretary has convened an FSOC working group that's in the process of developing an assessment of policy implications for crypto assets. The group is comprised of our two market regulators, the CFTC and the SEC, as well as the Federal Reserve Board, the FDIC, the OCC, and the BCFP. So at Treasury, in addition to the council staff and our domestic policy team, both FinCEN and our international affairs teams are very involved. So the Secretary has highlighted his concern about the role of crypto assets play in the range of illicit activities, and also is very interested in appropriate international coordination. So we decided to wait until that policy process played out, so we relayed a consensus of all the financial regulators on this really important topic, and we deferred that from the report as a result of that.
Okay, Counselor to the Secretary of the U.S. Department of the Treasury, Craig Phillips, thank you for joining us today.
Yeah, thanks for having me.
That's our show for this week. Remember, you can get access to all the shows we do here by either going to our website at cftc.gov or by getting out your phone and clicking on the podcast app and typing in CFTC Talks. Click subscribe if you want to get them every week. I'm Andy Bush, Chief Market Intelligence Officer for the CFTC. Thanks for listening. This has been CFTC Talks. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.